Welcome to The Explainer. Today, we're going to break down something that can feel, well, a little intimidating, corporate finance. But we're going to do it with a simple story, a parable really, about two companies. And the answer might just change how you think about building a business or even where you put your own money. So let's dive right in. Okay, so let's start with a choice. It's simple. You've got two companies, Company A and Company B. Both of them want your investment, but you can only pick one. So whose shares would you buy?
Now here's the thing. These two companies, they're basically identical twins. They have the exact same product, they're making the same amount of sales, and they have the exact same potential for future profits. I mean, they're clones in every way except for one really critical detail: how they got their funding. Company A, it's funding mostly by its owner's money, equity. Company B, on the other hand, is running mostly on loans, on debt. So just based on that one piece of information, which one are you leaning towards? Who gets your cash?
To really answer that question, we first have to agree on how we're going to measure success. And in business, that usually boils down to one word: profit. But here's the catch. Profit isn't just one simple number. It's actually a whole lot more interesting than that. Yeah, I like to think of profit like a waterfall. Right at the very top, you've got your total sales. That's all the money coming in. From there, you take out the direct costs of whatever you're selling, and boom, you get your gross profit. But we're not done. Next, you subtract all the other costs of running the business, marketing, salaries, rent, and that leaves you with your operating profit, or as the finance pros call it, EBIT. Now here's the step that's super important for our two companies. You subtract the interest you're paying on your loans. That gives you profit before tax. And then finally, after the tax man gets his cut, you're left with the big one: profit after tax, or PAT. This is the bottom line. For an investor like you, this is the number that really matters, because that's the money that actually belongs to the shareholders. All right, so now that we have our waterfall, let's run our two companies through it. And I'm telling you, the result is, well, it's a real surprise. Okay, check this out. Since they're identical businesses, both Company A and Company B start with the same operating profit, a solid $600,000. But then we get to those interest payments. Company A, with its low debt, pays just a tiny $15,000. But Company B? Oh man. They're loaded with debt, so they have to pay out a whopping $285,000 in interest. Now look at that final number, the profit after tax. Company A walks away with $351,000 in profit. That's almost double what Company B made, which was only $189,000.
So, case closed, right? It seems so obvious. You invest in Company A, it made way more profit. It feels like a no-brainer. But hold on, because profit, that's only half the story.
Let's look at this a different way. Let's look at it from the perspective of your wallet. Say you invested $100 in Company A. Based on their profit, your share of the earnings is $18. That's an 18% return on your investment. Not bad at all, right? Pretty solid.
Okay, now for Company B. Remember, they made way less profit, but for that same $100 investment, your share of the earnings is a staggering $189. That's not an 18% return, it's a 189% return. Let that sink in.
Wait, what? How is that even possible? How can one company earn literally 10 times more for its investors while doing the exact same thing? This, my friends, is the magic and the danger of what's called financial leverage. See, by using the bank's money, debt, to grow the business, Company B's owners had to put in way less of their own cash. So the profit they did make was spread over a much smaller ownership base, which means the return for each owner was massively multiplied. It's the ultimate high-risk, high-reward play.
So the answer is just to load up on debt, right? Go all in on leverage? Whoa, not so fast, because there is a huge, dangerous trap that every founder, every investor absolutely has to understand. And it's this: profit is not cash. I'm going to say that again because it's that important. Profit is not cash. You see, profit is really just an opinion. It's an accounting concept based on a bunch of rules and estimates. But cash is a fact. It's the cold, hard money sitting in your bank account. It's what you use to pay your employees, your suppliers, and, you guessed it, those huge interest payments on all that debt. So you could have a company that, on paper, reports a massive profit. Let's say $300 million. Everybody's happy. The shareholders are thrilled. The stock price is going through the roof. It looks like everything is absolutely perfect. And yet, that very same highly profitable company could look at its bank account and see it's $100 million in the red. They are, for all intents and purposes, bankrupt. They can't make payroll, they can't pay their bills,
They're profitable and broke at the same time.
So how on earth does that happen? Well, here's a really common example. Imagine a business spends $10 million in actual cash to buy a bunch of inventory. But when they calculate their profit for the year, they only count the cost of the inventory they actually sold. Let's say that's $6 million worth. What's the result? The accounting books show a fantastic profit. But the reality? $4 million of their cash is now just sitting there, collecting dust as unsold boxes in a warehouse. Profit is an opinion. The cash being gone? That's a fact.
Okay, so you get it. You understand the power of leverage, and you understand the critical difference between profit and cash. Now you can start using these ideas to make smarter bets on the future of your company. When you're thinking about big investments, I'm talking about building a new factory or launching a major new product line, you need ways to figure out if it's a good bet. One of the simplest tools is called the payback period. All it asks is one simple question. How long is it going to take to get my original cash investment back? Now think about our two companies. Company A, with its steady cash flow and low debt, might be perfectly fine with a project that takes a long time to pay back, as long as the eventual reward is huge. But Company B, with those massive loan payments due every single month, they need their cash back and they need it fast. They're almost certainly going to favor safer, shorter-term projects, even if the final payout isn't quite as big. So you see, at the end of the day, corporate finance isn't just about crunching numbers in a spreadsheet. It's really a strategic game. It's about balancing risk and reward, about understanding the trade-off between profit on paper and cash in the bank. And there's no single right answer for every business. So now that you know the rules of the game, the real question is, for you, which game are you going to play? Are you building a Company A focused on safety and stability? Or are you playing the high-stakes leverage game of Company B?